Okay, so that completes the taking stock of the 1 year performance and putting it in perspective. Try and look at it over slightly longer term horizons. Things seem to be more or less okay. Now we'll come to stock specifics, because there have been a lot of questions around the foreign stocks that we own and what is happening in those companies. Three broad worries can be there. Three broad questions can be raised. Not every fall in a stock price is a chance to buy, because sometimes the stock price falls and remains down forever, right? So the question is, are these stocks where the share prices have fallen, like a Enron or like a Kingfisher Airlines? So Enron was a out and out fraud where the books were cooked and people went to jail for that. Has some sort of a fraud come out in Alphabet, in Microsoft, Amazon, or Facebook? Answer is no. There's no fraud. Kingfisher was a very, very leveraged company. They were not able to pay salaries on time. They were not able to pay interest on their bank loans on time. Are these four companies very, very leveraged companies, or losing huge amount of money, not able to meet their cash flow requirements? Again, the answer is no. So let's put that aside and let's not worry about that. Even if a stock has fallen 20%, 30%, 40%, it doesn't mean that there is anything that is wrong at the very basic level with those companies. The other worry that people have is that some people have been around in the markets from late 90s onwards, and they have seen the earlier dot-com boom, where you had uh, all the what were called K10 stocks in India, and all the DSQ softwares and Silverline and Pentafor and all sorts of companies which were going at crazy valuations. And forget those companies, even companies like Infosys and Wipro were trading at very, very crazy multiples. So let's look at Infosys. This is a slide from Infosys. So the first red circle that is there, they had a profit after tax of 286 crores, right? And they had a market cap of close to 60,000 crores. This is late 90s. The price earning ratio was more than 200 times. This is Infosys in the year 2000, early 2000. March 31, 2000. Now look at what happened to the stock price. After peaking out in early 2000, the stock crashed and did not reach the earlier level for 6 years. So for 6 years, people were losing money on the stock. And mind you, there was nothing wrong with Infosys per se as a company. The company kept growing its sales and profits over the 6 year period. It is just that the starting valuation was so steep that people had a huge opportunity loss by holding on to Infosys, and they only broke even after 6 years. So, did we have that kind of a situation in the uh, Alphabet, Facebook, uh, Microsoft, and Amazon in the last few years? I would argue not. So, rather than just make a general statement, we will look at the individual finances of all these four companies, and we'll try and make sense of what the valuations were like, what the valuations are like now, and what prospects do we see for these companies going forward. So, we'll cover those individual companies separately, but the third broad question that comes to mind, and a lot of people worry about this, is that in the technology space, the pace of disruption is very, very fast. Something which is very strong or seems to be very strong today, a new competitor comes in and that company gets wiped out. So Yahoo was a dominant internet company in the late 90s, and today hardly anyone has Yahoo as their home page. It is still existing today, but people typically would go to Google or go to Gmail or go to Instagram or Facebook, or Yahoo is not their first internet company that they think about. MySpace, of course, I don't think it is there anymore. I haven't even checked. So MySpace or Orkut or these things are not around anymore. So this is the other thing people worry about. Are the companies that we are owning shares in, are they getting disrupted? Again, I don't think the answer is yes. I think these are very, very strong companies, and we will discuss each of these companies separately. Before we start discussing each of these companies, I've just put on screen some of the broad trends that we are seeing in the world today. Most of the people in this room today would be subscribing to either Hotstar or Netflix or Z5 or Sony Live or something like that. And if not subscribing, then would have YouTubes on their phones or on their connected TVs at home. And if you get used to streaming content on demand, you are not going to go back to linear TV saying, I'll sit in front of the TV set, I'll press a button on the remote, and I'll watch whatever serial or movie that the channel is broadcasting at that point in time. There's no going back. Once you get used to streaming, you will continue operating in streaming. Same way, all of these trends, once you get used to buying grocery at the press of a button and things getting delivered to your home, then it feels cumbersome to go to the big store and fill up your cart and stand in the line at the checkout counter. So e-commerce, streaming, AI, cloud computing. So all of these trends which are there are trends which have existed before COVID, got accelerated during COVID, are taking a breather now, but are trends which will continue in the coming decades as well. It's not that we are going back in time. And the companies that we own are very, very strong players in some of these areas, and they will be on the right side of the trends that are happening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.